If you're watching the Canadian housing market for signs of a crash, you're probably looking in the wrong place. For years, we have all been trained to watch three things: housing prices, sales volume, and mortgage rates. But the hard evidence now shows that the most accurate predictor of a coming foreclosure wave isn't the real estate market at all. It is parked on your driveway. The data reveals a direct, undeniable link between your car payment and the risk of losing your home. Most people treat their car and their house as a completely separate financial worlds, but the numbers tell a very different story. We're about to show you the evidence that what is happening in the auto loan market is the number one early warning sign of a housing crisis that is already quietly starting to unfold for thousands of Canadians. Stay with me as I connect the dots that most of the media is completely ignoring. Let's start with what almost no one is talking about. While all eyes are on the Bank of Canada and the house prices, a different kind of financial stress has been building, and it's getting close to the boiling point. I'm talking about auto loans. In the second quarter of 2025, an Equifax report showed that close to 1.4 million Canadians had missed a credit card payment. That's a jump of 118,000 people from the same time last year. The system is showing a deep crack. And the Bank of Canada's own 2025 Financial Stability Report confirms this, stating that while the mortgage holders have been resilient, signs of financial stress have increased and are concentrated among households without a mortgage. For those households, missed payment on a credit card and auto loans are now above their historic averages. This isn't a coincidence. This is the first domino. And the problem is being made worse by a perfect storm of economic pressures. The labor market, while appearing stable on the surface, is showing real signs of weakness. In November 2025, the national unemployment rate fell to 6.5%, but this number hides the more troubling reality. The job growth was heavily concentrated on part-time work, with the numbers of full-time positions actually falling, making it a lot harder for them to manage their debts. As Statistics Canada noted in October 2025, the number of unemployment people for every job vacancy has significantly increased from the previous year. So while people may have jobs, the quality and the stability of that employment is weakening, making it a lot harder for them to manage their debts. On top of that, the cost of just owning a car has exploded. Higher interest rates, bigger loan amounts from the inflated vehicle prices, and soaring insurance costs are squeezing household budgets like never before. This isn't just a few people making bad choices. It's a systemic problem. People need cars to get to work and to live their lives, but that very asset that provides them the freedom is now becoming a financial trap. And the data shows that when the trap springs, the car is often the first thing to go. So why is a missed car payment such a powerful predictor of a future mortgage default? It's because for most families, the pecking order in a financial crisis is brutally consistent. You miss a payment on a credit card first, then you fall behind on your car loan. The absolute last payment anyone ever misses is their mortgage. Nobody wants to lose their home. That's what makes auto loan delinquency such a powerful leading indicator. It tells us not where the crisis is now, but where it's going. Even the Canada Mortgage and Housing Corporation, CMHC, has warned that rising delinquencies in credit cards and auto loans are leading indicators that suggest mortgage delinquencies will continue to increase in 2025 and 2026. Think about the real-world consequences when a household is under so much financial pressure that they can no longer afford their vehicle. The lender eventually sends a tow truck. That repossession isn't just about the loss of a car. For many, it's the loss of their ability to get to work. It's the loss of income. It's the shock that pushes a family from struggling into sinking. This isn't about personal failure. It's about a system where the cost of living and the cost of debt has outpaced wages. We are seeing a growing divide between households that have a mortgage and that they don't. According to Equifax, in the second quarter of 2025, the percentage of consumers who missed a payment was nearly double for non-mortgage holders compared to those with a mortgage. The gap has more than doubled since 2019, showing just how fragile a growing part of this population has become. These are the very people who might be trying to get into the housing market or are already stretched thin as renters. The stress is particularly sharp for younger Canadians. Equifax data shows that for the consumers under the age of 36, the 90-day non-mortgage delinquencies rate jumped nearly 20% year over year. This is the generation facing a slower job market and a crushing cost of living. They are a massive part of our economy and they are flashing a giant red warning light. This is just the start. The pressure that begins with a car payment doesn't end there. It builds and it transfers, and its final stop is the housing market. Here's the core of the issue. The data connection that predicts the next wave of foreclosures. For the past several quarters, we have seen auto loan delinquencies climb. TransUnion Canada reported that 60-day auto delinquency rate in the second quarter of 2025 was just 1.31, a level higher than what was seen during the 2008-2009 recession. Now, watch what's happening in the mortgage market. On the surface, the national mortgage delinquency rates still seem low. As of the second quarter of 2025, the national rate was just 0.22%. This is the number that most banks and analysts point to when they say everything is fine. But they are missing the whole trend. They are looking at the destination, not at the direction of the travel. The danger isn't the current level. It's the alarming rate of change, especially in Canada's most important housing market. In Toronto, the mortgage delinquencies rate surged 60% year over year between the second quarter of 2024 and 2025, hitting a level not seen over a decade. In Ontario, the overall mortgage delinquency rate has now risen to 0.23%, ticking just above the national average for the first time since 2012. British Columbia has also seen its rate steadily increase. This is not a coincidence. This is a pattern. The rise in auto delinquency that started over a year ago is now starting to show up as a rise in mortgage delinquencies. Even the big banks are preparing for this. As has been reported through 2025, Canadian banks have been significantly increasing their reserves for expected credit losses, setting aside more money for future defaults. They see what's coming. They are prepared for the wave to hit. This isn't a theory. The Bank of Canada itself has acknowledged the connection. In its analysis, it noted that for the households without mortgages, the rate of arrears on credit cards and auto loans have risen further and are above their historical averages, while for mortgage holders, those same rates are still below average. This clearly shows where the financial stress is concentrated and where it will spread next. So what happens when this pressure finally breaks the surface? We are currently in what many people have called the Great Mortgage Standoff. Sellers don't want to sell for less than what the peak price is, and the buyers can't afford the current high interest rates. This has created a market that looks stable, but it's an illusion. The rising tide of auto loan defaults is the force that could break the standoff. As more households get pushed to the financial brink, they will lose their power to choose. They can no longer afford to wait for a better price or lower rates. They will be forced to sell. This is how a foreclosure wave begins, not with a bang, but with a quiet, desperate need for cash. Somewhere around 2 million Canadian mortgages are set for renewal between 2025 and 2026. Many of those were taken out when the interest rates were at historic lows. Despite recent cuts, most of these households will face significantly higher payments. For a family already struggling to make their car payment, this mortgage renewal shock could be the final blow. We are already seeing the stress manifest in most vulnerable parts of the market. Delinquency rates for the private mortgage lenders have reportedly been climbing, reaching levels multiple times higher than the rates at the major banks. These are borrowers who couldn't qualify at traditional institutions and are the first to fall when the financial conditions get tight. The evidence is clear. The economic pain that started in the auto loan market is now migrating to the mortgages. The trend is established and it points to a continued increase in mortgage default and forced sales over the next 12 to 18 months. It won't be evenly distributed. It will hit hardest in the regions like Ontario and British Columbia, where high living costs and elevated mortgage rates are creating the most pressure. This isn't a forecast to create fear, but a data-driven warning to create awareness. The numbers don't lie. The connection between auto debt and housing risk is real, and it's happening right now. The question is, what are you seeing on the ground? Are you noticing more signs of financial stress or panic selling in your community? Let me know in the comments below. Your on-the-ground experience is a critical part of understanding the real story. If you need to sell your property as soon as possible, please give me a call at 416-845-9872. For the past year, the story of Canadian housing market has been about interest rates and sales figures. But the real story, the one that will define the next chapter, is about household financial fragility. It's about the fact that for millions of Canadians, the system is broken. The undeniable rise in auto loan delinquency is more than just a statistic. It's the number one early warning sign of coming foreclosure wave. It's the proof that deep financial stress is building just beneath the surface of the economy. While the official mortgage default numbers still look manageable today, the leading indicators are all flashing red. The pressure is building and the link is clear. What happens in the driveway today predicts what will happen in the front door tomorrow. The only question now is, how widespread will be the damage when the wave finally hits? Until next time, see you soon.